Theft by the owner starts when this separation is ignored, whereby you as the owner do not separate yourself from the business. And this is how it happens. It happens in one of two ways. Statistics often show that most businesses fail within the first 2 years of operation. And I know most of you have this question: what kind of business can I start? What business is profitable? I mean, I'm looking to leave employment to start my own business. What kind of business should I start? What businesses make profit? And how do I keep this business for long? And we know that the economic situation is not good. There are taxes, there are all those things that people talk about. But there's one thing that often is ignored: theft by owner. I mean, have you ever thought of a situation whereby you'll find someone being arrested and taken to court, and the charge sheet reads that so and so stole from the business? I highly doubt it. But it's one of the reasons why your small business or medium business will fail, because you as the owner stole from your business. Let me use accounting concepts to explain. Let me explain. Theft by owner. Let me explain. I see people running out of business, and definitely the most obvious reason that people give kwa nini biashara imeanguka ni hard economic situations, ama pesa haingii vile inafaa, etc. But I think there's this issue yenye people don't really talk about it a lot. Theft by owner. And I know you're wondering, like, how do I steal from myself? As in, biashara ni yangu, ideas ni yangu, hustle ni yangu, like I struggle so much. Then why shouldn't I take from the business? Why shouldn't I pay myself? But you'll realize that in accounting, there's a concept that is supposed to help you avoid from stealing from yourself. So the moment you learn that concept, the moment you understand that concept, then you'll understand why this is a real issue and why you could also be stealing from your business. So if you've ever had a business that failed, I want you to go back in time. Go back. Jiutaka mkutano. Jiulize, am I the one who stole from my business? And if so, what should I do to avoid that? This is the accounting concept that will help us understand that. It says that you and your business are two different entities, meaning that you should treat your business as someone else other than you. So if you're holding money that belongs to the business, then that money belongs to the business. If the business pays you, then that is your money. If you mix the two, then there's definitely going to be an occasion where you'll find that you're stealing from the business. Someone asked me, is it possible that the business can also steal from you? Yeah, but maybe that will be an issue for another day. So then, what is you and what is the business? So you are the owner. You have a sole proprietorship, you have a partnership, you have a company, you have whatever kind of business that you have, but that is you. Then there is the business. So now the next question is, how do you define a business? What defines a business? And I'll explain these using 3 terms. One of the terms that people have often used and sometimes misused is the term asset, or in this case, assets. The other term that people have often used and again misused is the term liability or liabilities. And Another term that I will add is capital. Now, to understand that, again, I want you to help me think of it this way. If you were to start a business, what business would it be? Okay, I can guess some of you will say a boutique, others will say wines and spirits, others will say cereals, whatever you say, logistics. I want you to answer now this question. What do you need to start that business? If you said capital, raise your hand. Almost all of you said capital. But it's not capital. What you need to start your business, probably it's more of a language thing than a technical thing. Unahitaji nini kuanza biashara yako ya serious? Basically, what you should tell me is the kibanda, and that kibanda will be made up of mbao or such things, and you'll have to make it up. You'll also need the containers where you'll put your cereals and all that. You'll also maybe need a display shelf. You'll need the actual things that you're selling. That is the stock. And you'll need cash to run around and for what you'd call working capital. Although I don't use the technical terms a lot, I want us to get there pole pole. So you agree with me. To start a cereals, this is what you need. So now our answer has changed from capital to actual, tangible, conceivable items that will define our cereal business. If you want to start a hotel, then what do you need? Now, instead of answering capital, think of the things that you go into a hotel and find. The furniture, probably a TV, the stock, the display shelf, all those things. If you go to a barber shop, you'll definitely find things that are different from what you'll find in a cereals shop. Now, these items or these things that you need to start have a value. So by the time you're saying that you need 20,000 shillings to start a cereals shop, you've calculated that the kibanda will cost probably 5,000, the containers 4,000, the display shelf 3,000, the stock 7,000, and the cash to run around 1,000. So we started with the question, what do you need to start the business? You probably answered capital. Then I took you back to your thoughts and I told you to think of tangible, realistic things. You said kibanda, you said containers, you said stock, you said cash. And then I asked you, how much would it cost you to start the business? You said this amount, but broken down in these ways. 5,000 for the kibanda, 4,000 for the containers, 3,000 for the display shelf, 7,000 for the stock, 1,000 for the cash you need to run around. So the next question is, so this is what you need. Where do you get it from? Or rather, who supplies the business with these items? So what we have been defining are the assets. So actually the correct answer to the question, what do you need to start a business, is the assets, the items. So assets are things owned by not the owner, but by the business. Remember, we already have this wall of separation between you, the owner, and the business. So assets, things owned by the business. Now, the next question is, who supplies these things to the business? A simple answer could be you, that you supply these things to the business. So somewhere from your savings, you have the 20,000 shillings. So we would say that these things have been supplied by you. And what you supply to the business items supplied by owner is what we call capital. So if you have this 20,000 from your savings and you say that I need 20,000 in form of assets and I have the 20,000, then would complete our equation that assets equals capital. That what the business needs, what the business owns, has been supplied by the owner. So the owner has invested 20,000 in the business. And it should be complete like that. Until or unless the owner doesn't have that money. So there could be two situations whereby you're very passionate about starting a serious business, you don't have any money, you go to a friend and the friend tells you, I will loan you the 20,000 that you need to start the business. So meaning now you have the 20,000, which is not your money. It's money that belongs to a third party. So now these items have been supplied by a third party. And that is what we'd call a liability, 20,000. Again, our equation is complete, that our assets have been brought out by 0 owner's capital and 20,000 third party's money. So the next thing that I'll say already will make sense, whereby the owner has only 10,000, so they'll only need to borrow 10,000. Again, it completes our equation that what the business needs, what defines the business assets, has been supplied to the business by the owner, capital, and by loans, liabilities, or by the third parties. So that's the first, or rather now we have already explained two concepts. One, business separation. You are separate from your business. What you supply to your business is capital. But whenever you supply it, it stops being yours. Now it belongs to the business. Now, let's go to the next part. You've already started your business. So the next thing you need to do is operate the business or run the business. By running the business means now you're converting the assets into income. You're converting the stock, you're converting the items that supporting the stock to income. You're generating an income through sales. So this is what I'd expect in a normal business, that you're making sales by selling a certain number of units at the end of the day and getting a certain amount of money at the end of the day. Let's assume that you're getting 5,000 shillings. You have considered things like a good location, you've done good marketing, and God has favored you. You're making good income, 5,000 shillings per day. Yet, this is not your income for the day, because you have what you'd call the cost of making that income, or in our case, the cost of sales. And this is applicable to all businesses. If you run a boutique, definitely you're selling some clothes. If you have a social media, you're a social media agency, you're selling adverts, you're influencing. So definitely you have your income that you're making, and you have the income or the costs of generating that income. So like in our kibanda where we are selling the cereals, it means to be able to sell cereals worth 5,000, we must have first purchased cereals worth a certain amount of money, probably 3,000 shillings. So at the end of the day, you're generating an income, but we call this income our gross profit. 2,000. So if you're making 2,000 shillings in a day, gross profit, that is good, but still not complete, because you have things we call running expenses. And these running expenses means that you have employees, maybe not in the kibanda, but in your other businesses, you have employees. If it's in your hotel, you have to pay them a daily rate. You have bills for electricity. You have to call customers, so you have bills for airtime. You have to move from point A to B, so you have fare expenses to account for. You think about all of that. And where you've built your kibanda, maybe that ground belongs to someone, so you have to pay rent at the end of the month. So I will categorize these expenses into three. One, the expenses that you incur every day because of you're making sales, like salaries. And in this case, I'll assume you're paying only yourself in the kibanda, so 500 shillings for your labor. And then the expenses that you have to incur, whether you sell or not. And one good example is rent. So if you take someone's property and rent it for your business and you don't show up for the full month, the person will not care whether you made sales or not. They'll still want you to pay something, or rather the rent. Let's assume that you've accounted for 500 shillings per day. Again, this is an example. It will depend with what business you're doing. It will depend with your location. It will depend with a lot of other things. But for the sake of illustration, let's assume that's the case. And if you have taken a loan and that loan has an interest, you'll probably incur what you'd call the financial costs, a certain amount. So at the end of the day, you have 1,100 as your expenses. So now you can calculate your net income or net profit, which in this case would be 2,000 gross profit minus the 1,100 expenses to make 900 your income. Now, notice this net income, now it has been generated by you, by the business, but it belongs to you. So the return to the investor is the profit, not the sales, not the gross profit, but the profit. And in this case, you have also catered for the liabilities. You've paid the costs of having a loan, that is what you're calling the interest. But also, again, note in this case that this net income, in most cases, it could also be the cash that you're having in hand. But in realistic, real life kind of businesses, it doesn't always represent the cash that you're having. For instance, what if you made all these sales on credit? Meaning, no one paid you this money. No one paid you for the sales that you made. You sold cereals to 4 or 5 people, maybe a school or a certain organization, and said they'll pay you at the end of the month. Yes, you've made a sale, but you've not received the cash. So as much as you're accounting your profit for the day, you realize that you're not holding the cash. And that is why one of the basic assets that you're required to have is cash. But as long as that cash belongs to the business, it shouldn't be mixed with the cash that you have in your pocket. Now, if you run this business well, correctly, you faithfully generate your sales. From what you've generated, you go buy more stock for the next day, you sell, you earn your profit, you pay yourself. Remember, you need to move from home to where you are working. You need to eat lunch. That is why you need to pay yourself. You have to cater for rent, because at the end of the month, that premises doesn't belong to you. You need, if you've taken a loan from someone, you need to cater for the interest. And you can now decide whether to eat or reinvest. I mean, that is up to you. That is why you go to the business every day, because you want to be able to generate some money that can help you pay for your personal expenses, rent, school fees for your kids, etc. And if you eat all of it, then that might mean that your business might not expand. If you decide to eat a portion and reinvest the other portion, then that means it will be able to help you generate more sales and all that. Still, we haven't reached the point where you're stealing from yourself. But let's go to that point now. Theft by the owner starts when this separation is ignored, whereby you as the owner do not separate yourself from the business. And this is how it happens. It happens in one of two ways. One, if you are selling your cereals at the kibanda, and you remember that at the end of the day you need to eat also, and instead of maybe going to buy cereals from another person or even from yourself, you just go to one of the containers, you draw some rice, you draw some beans, you draw some dengu, or whatever other cereals that you need. If it's a retail shop, you take milk, bread, sugar, whatever else you're taking, or sometimes even not for yourselves, but a friend comes, they give you a sob story, and you're like, okay, take this sugar, take this milk, take this whatever, so that at the end of the day, you find that whatever you are, as much as you've sold the stock, you haven't generated the revenue. That is, you sold some to yourself and to your relatives, but they didn't pay because you're thinking, since I have the business, then this is mine. So what happens? The next day, you find that the sales that you have generated should be even more than 5,000, but the revenue that you have earned is 4,000 shillings. Simply because you took some goods or some items of stock for own consumption. And what does that mean? It means that when you go to the market the following day to buy stock to resell, normally the sales that you made the previous day will dictate how much money you have enough to buy the stock for the following day. But since you already consumed some, it means you'll not be able to generate as enough money to buy enough stock as you'd have required. So you end up buying items worth 2,500, generating you a gross profit of 1,500. If we assume that our expenses remain the same, you have to pay yourself, you have to pay to put aside some money for rent, you have to pay your liabilities cost, that is interest. Then, if you minus the 1,100 in expenses, your income falls from the 900 that you had to 400 shillings. So basically, what has happened to the 500? You've stolen from yourself. Simply because when you made sales, you didn't recognize the revenue from that, either by selling to your relatives or actually buying the stock for yourself. But now, the worst part comes in when you use this asset called cash for your own good. Because you will have emergencies. You will have people calling you with that need mchango, that need money to do this and that. And since in your cash till, there is money, there is an asset that belongs to the business, but because you have removed the separation that the business has from you, then you assume that this cash belongs to you. So what do? You use that cash, you give out that cash, you contribute to Harambes, you send your pastor some money, and before the blessings come, what happens to your sales? Your sales fall further because the amount you have can only buy you stock worth 1,000 shillings. So your gross profit is now 1,000 shillings. If your expenses remain at 1,100, now you're already making a loss of 100 shillings in the day. But because, again, there is no separation between you and the business, you still find yourself carrying some cash around. Yeah, you find yourself maybe living comfortably because you can be able to move from point A to B. You don't have proper records. But over time, this will catch up with you. People will come, they want dengu and rice and all that, several varieties, but you only have one because you've already used the cash that belongs to the business. And eventually, you end up closing the business. People ask you what happened. You say business is hard. Talk about the taxes. Talk about having bad luck. But essentially, what did you do? You stole from yourself. That is theft by the owner. Till the next one, this is JephKafka TV.